Okay, let's break down how to calculate the price to sales PS ratio and analyze its meaning with an example. What is the price to sales PS ratio? The price to sales PS ratio is a valuation metric that compares a company's stock price to its revenue. It indicates how much investors are willing to pay for each dollar of a company's sales. It is primarily used to value companies that don't have earnings, e.g., growth stocks, or are temporarily experiencing losses. Formula: price to sales ratio, PS, equals market capitalization divided by total revenue, or price to sales ratio, PS, equals stock price per share divided by revenue per share. Market capitalization: the total market value of a company's outstanding shares of stock. It is calculated by multiplying the current stock price by the number of outstanding shares. Total revenue: the company's total sales revenue for a specific period, usually the trailing 12 months or the most recent fiscal year. Stock price per share: the current market price of a single share of the company's stock. Revenue per share: the company's total revenue divided by the number of outstanding shares. Steps for calculation: determine market capitalization. Multiply the company's current stock price by the number of outstanding shares. Obtain total revenue. Find the company's total revenue for the relevant period, trailing 12 months or the most recent fiscal year, from the company's financial statements, usually an annual report or 10-K filing. Calculate the PS ratio. Divide the market capitalization by the total revenue. Or, using per share data, find stock price per share. Obtain the current market price of a single share of the company's stock. Calculate revenue per share. Divide the company's total revenue by the number of outstanding shares. Calculate the PS ratio. Divide the stock price per share by the revenue per share. Example: let's say we want to calculate the P to S ratio for Tech Giant Inc. Stock price per share, $50. Number of outstanding shares, 100 million. Total revenue, trailing 12 months, $2 billion. Method 1, using market cap. Market capitalization, $50, stock price, times 100 million, number of outstanding shares. 100 million shares outstanding equals $5 billion. Total revenue, $2 billion. PS ratio, $5 billion divided by $2 billion equals 2.5. Method 2, using per share data. Stock price per share, $50. Revenue per share, $2 billion divided by 100 million shares. Outstanding equals $20. PS ratio, $50 divided by $20 equals 2.5. In this example, Tech Giant Inc. SPS ratio is 2.5. Analysis and interpretation. A PS ratio of 2.5 means that investors are willing to pay $2.50 for each dollar of Tech Giant Inc. S sales. Lower PS ratio generally suggests that a company is undervalued or that investors have lower expectations for future revenue growth. Higher PS ratio typically indicates that a company is overvalued or that investors have high expectations for future revenue growth. Factors to consider when analyzing the PS ratio. Industry. PS ratios vary significantly across industries. Compare a company's price to sales ratio to the average price to sales ratio of its industry peers. Some industries, like software or technology, tend to have higher PS ratios due to their growth potential. Growth rate. Companies with higher revenue growth rates often have higher PS ratios. Investors are willing to pay a premium for companies that are growing rapidly. Profitability. The PS ratio doesn't consider profitability. A company might have high revenue but low profits, which could make its P to S ratio misleading. Competition. The competitive landscape of the industry can affect P to S ratios. Companies with a strong competitive advantage may have higher price-to-sales ratios. Historical trends: track a company's PS ratio over time to identify trends and potential valuation changes. Limitations of the PS ratio: doesn't reflect profitability. The PS ratio only considers revenue and ignores expenses and profits. Can be misleading. A company with high revenue but low profits might appear attractive based on its PS ratio, but it might not be a good investment. Industry dependence: PS ratios need to be compared within the same industry to be meaningful. When to use the PS ratio: valuing growth stocks. The PS ratio is useful for valuing growth stocks that don't have earnings or have inconsistent earnings. Comparing companies in the same industry: PS ratio can be used to compare the valuation of companies within the same industry. Spotting potential value: a low PS ratio might indicate an undervalued company, but further research is needed. In summary, the price-to-sales ratio is a valuable tool for assessing a company's valuation relative to its revenue. However, it should be used with other financial metrics and qualitative factors to understand a company's financial health and investment potential comprehensively. Follow vpcontroller.com for more content like this.